Guys, I hope you're doing well. James here from jamesdforsythe.com, and we're just continuing the money and payments white paper done by the Federal Reserve for a possible central bank digital currency. Um, Going over more of this video will be specifically about like the different characteristics and purposes and maybe even functions and such of their possible central bank digital currency. So anyways, we'll get right into it. Head over to screen share. Click OK. So there's that. And then I'll make sure that you guys can actually see it. There we go. All right. Okay, so with digital assets, a lot of the reasons why this is kind of a main consideration is what's been going on with crypto and stuff recently, or I guess the past few years at least, and how much popularity it's gained. So cryptocurrencies have not been widely adopted as a means of payment in the United States. They remain subject to extreme price volatility and difficult to use without service providers, and have severe limitations on transaction throughput. Um, and also, many cryptocurrencies also come with a significant energy footprint and make consumers vulnerable to loss, theft, and fraud. Um, Again, this is their words, not mine. I don't see much of a difference between from these statements alone. I don't see a difference between that and U.S. dollars, like whatsoever, really. Specifically, with consumers vulnerable to loss. Well, inflation's at like 8.3% in this past April, I think, year over year. Um, And then theft, I mean, you can steal US dollars. It's not new. And same thing with fraud. Like, that's nothing new. Um, and then, I mean, in terms of the energy footprint, I don't really want to get into that argument. But if you go into this PDF, there's also, they have it looks Forbes Advisor um, article posted in in the footnotes, so you can actually read whatever they're citing for that. Again, that's not really what I plan on getting into. Um, if I can just scroll correctly. Also, there's something called the PWG report, and I don't remember what that was off the top of my head, what it stood for. But it notes, however, that the potential for increased use of stablecoins as a means of payment raises a range of concerns related to the potential for destabilizing runs, disruptions in the payment system, and concentration of economic power. Uh, this report highlights gaps in the authority of regulators to reduce these risks. Right. And so this was some government report, if I remember correctly. And I just think it's funny that this is coming from the Fed, specifically with the whole concentration of economic power. And like, really? And even that, I mean, I don't see how there's much of an argument, at least off of the top of my head. Just even if you're talking about the commercial banks and how that kind of came to be with our current banking system, and you're only looking at the commercial banks, even before the Federal Reserve Act in 1913, it was still like, I guess you could argue that kind of the 1800s. Let's see, when was it? It was after the Civil War, before, so like 1860 to 1912, 13, whatever. In between the Civil War and the Federal Reserve Act, what was kind of deemed wildcat banking. If you, I guess you could kind of compare that period to where cryptocurrencies are now, which from what I can tell, and every time I see them, just kind of Federal Reserve people in general talking about this kind of stuff, with this, like specifically like with the concentration of power and then the privacy concerns and the destabilizing runs and disruptions and stuff like that. um they have a very, very similar argument with why the Federal Reserve needed to be created or whatever in the due to that wildcat banking period. um Now, whether or not that's an accurate analogy, I'll leave to you and to your study of history. But I'm just kind of pointing it out that it raises eyebrows, to say the least. But to get more specific on the central bank digital currency part, so the Federal Reserve notes that physical currency are the only type of central bank money available to the general public, and we kind of got into this a little bit um, in the previous video last night about the different types of money. So the central bank money is a liability of the Federal Reserve themselves, and so the physical currency is the only central bank liability that a individual person can have, right? And so as a liability of the Federal Reserve, however, a CBDC, a central bank digital currency, would not require mechanisms like deposit insurance to maintain public confidence. And so this is like the FDIC, the Federal Deposit Insurance Corporation. The whole like your bank account um, is insured by the FDIC by I think it's up to $250,000. So they're saying that's what invokes public confidence in commercial bank liabilities, the dollars in your bank account. So to continue, nor would a CBDC depend on backing of an underlying asset pool to maintain its value, i.e., deposits. A CBDC would be the safest digital asset available to the general public with no associated credit or liquidity risk. And we talked about this a little bit in the previous video about the whole like I would, I guess. You have to kind of get into the questions like at what cost would a CBDC kind of, especially with the credit risk, because the whole with the liquidity risk, I don't see an argument against it. I think that's 100% correct. I mean, like the whole point of a central bank digital currency is they can just just create as whatever they want, whatever they need at a whim, whatever. That's kind of the whole point of this specific one. Um, and so I don't think, or at least I don't see an argument against a CBDC having liquidity or not having liquidity risk. But on the other hand, when you're having the credit risk, it's like, okay, at what cost? I mean, like if they just essentially, if bank reserves become legal tender, so to speak, which would essentially be what a CBDC is, um, then the whole credit thing goes out the window, and you're looking at a much different macroeconomic backdrop and possibly even a history for the U.S. financial system. Because especially with this kind of transition, with this central bank digital currency, one of the arguments that it seems to me that if a central bank digital currency were to come into being, the argument that hyperinflation would be much more imminent is much more, I think, is much more probable, because you have these, excuse me, these bank reserves, essentially, digital central bank liabilities, so to speak, becoming legal tender for the individual themselves to use. Um, Meaning the Federal Reserve no longer has to go through the commercial banking system to get dollars on non-bank entities' back balance sheets. So basically, you're having, because with the current system, yes, the government, that's a misnomer. Yes, the Federal Reserve can quote unquote print bank reserves and basically increase the amount of bank reserves on commercial banks' balance sheets, but that doesn't directly change the amount of money on the balance sheet of non-bank entities, of people in the real economy, of businesses, of individuals, and so on. Not necessarily. That's why there's the whole kind of misconception of quantitative easing being money printing. Kind of. it depends on where those assets are coming from and who the Federal Reserve is purchasing them from, right? Yes, they're getting them directly from the primary dealer banks, but where did that dealer bank get it from? And that's where it kind of depends on where we're having commercial bank liabilities pop up in the real economy. And that's when you're seeing problems with inflation, is when the dollars are getting straight into regular people's accounts and balance sheets so that they can spend it in the real economy. And that's what bids up prices, right? Um, so there's that. I'm going to continue on to try not to rant very much. So let's see. Right here. So while no decisions have been made on whether to pursue a CBDC, um, analysis to date suggests that a potential US CBDC, if one were created, would best serve the needs of the United States by being privacy protected, intermediated, widely transferable, and identity verified. And so this is the part to where it gets much more interesting, I think, on kind of the angle they're looking at this, right? And so privacy protection, obviously, it's the same thing with like all bank accounts when you set them up. I mean, that's people's money is a very important thing, because without that you don't eat, right? You don't have a house, whatever. Um, so privacy protection is a big deal, and that's where you see a big kind of I don't know if I'd say movement, but most of the arguments against a central bank digital currency is because of the privacy, right? They don't want a centralized entity being able to know every little transaction they do. Um, who can blame them? But so there's that, and that part's kind of self-explanatory. I'd hope it'd be kind of at least more well known, I guess. Mostly what I'm talking about, what's interesting is the intermediated part. And so the Federal Reserve Act doesn't, I'm going back to reading verbatim, the Federal Reserve Act does not authorize direct Federal Reserve accounts for individuals, and such accounts would represent a significant expansion of the Federal Reserve's role in the financial system and the economy, like the Federal Reserve Act has prevented them from doing stuff before. But that's a topic for a different video that we'll get into later, um, in the future at some point. So, potential intermediaries would include commercial banks and regulated non bank financial service providers, and would operate it in an open market for CBDC services, right? And so, a lot of the times, um, not a lot of the times, um, the main kind of argument, or at least what I got from the initial reading through this paper, was that essentially the Federal Reserve will have this central bank digital currency, and then that'll still have to be transferred through the commercial banks, but it is no longer the liability of a commercial bank, right? And so essentially, the Federal Reserve will have some say in creating as much as they want. They don't have to rely on the banks to loan out more money, right? As they do now. Um, so there's that. And then there's also conversations about like a narrower purpose CBDC, as you see in the footnotes, could also be developed, such as one designed primarily for large value institutional payments and not widely available to the public. So even possible like having multiple central bank digital currencies for different purposes, kind of similar to how what we have now with like you have cash, which I think the statistic is later in this paper, to where it's like cash is mostly used for like transactions less than $25. I mean that's what I pretty much use it for. Unless I'm buying a car from someone or something, pretty much all of my cash transactions are relatively small. Um, and then if you use depending on uh our larger transactions, it'd be more like you do with like the automated clearinghouse or checks or whatever you wire transfer, whatever other mode you prefer. So I guess I'm kind of getting ahead of myself, not actually answering the question. But so you have kind of the money that regular people use, like the cash and your bank deposits and such. And then you have ones for large financial institutions who aren't holding cash. They're holding, say, um, like treasury bills and stuff, to where they kind of use that as a kind of form of cash in a way. It's just one that actually pays interest. And they actually make this distinguish. They actually make this distinction um, in this paper as well, is maybe having multiple central bank digital currencies, one with no interest and one that does pay interest, which I guess is kind of where they're playing with this idea of having it for some for very large institutions and some for just individuals. Um, right. And so an intermediated model would facilitate the use of the private sector's existing privacy and identity management frameworks, leverage the private sector's ability to innovate, and reduce the prospects for destabilizing disruptions to the well-functioning U.S. financial system. Talked a little bit about that already with the destabilizing stuff. Transferability. So let's see which one. The ability to transfer value seamlessly between different intermediaries makes the payment system more efficient by allowing money to move freely throughout the economy. Basically, just being able to transfer stuff. And then with the identity verified stuff, essentially just using this commercial banks for what they already have for infrastructure for identity verification. So yeah. And then you have uses and functions of it. So individuals, businesses, and governments could potentially use a CBDC to make basic purchases of goods and services or pay bills, and governments could use a CBDC to collect taxes and make benefit payments directly to citizens. UBI, which should not be a surprise. That's been kind of whispers in I'm going to call it the macro geek community, because I don't know if it's really a community per se, but like a lot of the people that like I listen to, whenever they were like they've been talking about central bank digital currencies for years, right? At least two that I can say for sure, and that was always kind of the whole point, was they'd roll out, or the idea is it would make sense to roll out UBI, which is universal basic income, if you don't know what that means. Basically like guaranteed paychecks from the government, no matter what, no matter if you're employed or have a job or do whatever, everyone gets one. Probably with exclusions for whatever they have, whatever's politically viable at the time. And then basically that a good time to do that would be with a central bank digital currency, because it'd make it pretty easy to just do it. So yeah, and then potential benefits for a CBDC. So could potentially serve as a new foundation for the payment system and a bridge between different payment services, both legacy and new. It could also maintain the centrality of safe and trusted central bank money in a rapidly digitizing economy. Basically, they don't want to lose their kind of hegemony over money, so to speak. So, all options for private digital money, including stablecoins and other cryptocurrencies, require mechanisms to reduce liquidity risk and credit risk. But all these mechanisms are imperfect. So, talking about how, like, the private non-bank money, which we talked a little bit in the previous video, how that's basically like more risky in every form is what they talk about, and that can be regardless. Sorry, that's a pet peeve of mine. I hate my phone going off all the time. I don't like successive notifications. Anyways, I lost my train of thought. Sorry. So yeah. Okay, so proliferation of private digital money would present risks to both individual users and financial systems as a whole. A U.S. CBDC would mitigate some of these risks while supporting private sector innovation. Right? It's the same argument that you see with pretty much all of, at least with banking reform. it seems, throughout history. When you look at like even the creation of the Federal Reserve, the whole like one of the major talking points for the Federal Reserve Act was the fact that it was you have to, if you're going to reform any like the monetary system in like almost any form, it seems you have to play it in such a way that it seems like it's protecting consumers, regardless if it is or not. That part doesn't matter. What actually matters is it um what matters to them is, does it seem like it'll protect the consumers? And that seems like a very overarching theme that you see with almost all of these. Like I can't think of like a very specific piece of say legislation or regulation on like some form of or some entity in the financial or monetary system to where it wasn't spun in that way, that it was going to protect individuals and so on, regardless if it did it or not. um and then there's also the supporting private sector innovation. Again, since the private sector wouldn't have control over the money itself or the central bank, the currency itself, um, it seems like they're talking more of it for the services that they provide, and they don't really clarify what those are in this paper. Maybe that's for further comments or whatever, or I don't know. I didn't notice it in this paper itself. Um, so a central bank digital currency might also help to level the playing field in payment innovation for private sector firms of all sizes. For smaller firms, the costs and risks of issuing a safe and robust form of private money may be prohibitive. Okay. um, I don't. It's kind of like, especially with cryptocurrencies, it seems like that kind of almost fixes that. I mean, pretty much anyone can create their own protocol in some form. So I don't know about that. So finally, a CBDC might generate new capabilities to meet the evolving speed and efficiency requirements of the digital economy, as noted above. For example, a CBDC could potentially be programmed to deliver payments at certain times, going back to the universal basic income again. Um, Talking more about cross-border payments, we talked about this in the previous video as well. Basically about remittance payments from immigrants, and they also say small businesses buying like goods and services from them, to where they can't do those types of international transactions at scale a lot of the times, according to them at least. Um, so, but there's also like, I can see the problems with jurisdiction and kind of the legalities of it going between countries. And so you'd kind of have to, okay, not only does this have to pass in the United States, but it also has to go with the foreign countries if this were to be used for cross-border payments. Um, so yeah, and then again, got to support the U.S. dollar. It's pretty much the whole point. Um, I don't know if it's the whole point of this per se, but you hear it's a major incentive for the Federal Reserve to maintain the U.S. dollar like hegemony, right? Same, it's kind and to the advantage of Americans too. Um, I mean, you have like even just look at what's been going or what went on, I guess, with Russia, Ukraine, and like the freezing of Russia's assets, and basically the United States using the currency as a weapon. And this isn't the first time either. That's what happens when you have a reserve currency. Um, it's used for political purposes. But anyways, so another potential benefit of a U.S. issued CBDC could be to preserve the dominant international role of the U.S. dollar. Again, it's a network effect. The dollar's international role also allows the United States to influence standards for the global monetary system. So, big brother in everyone's backyard. Um, and then if these new CBDCs were more attractive than existing forms in the US dollar, global use of the dollar would decrease. And the US CBDC might help preserve the international role of the dollar, right? So basically, the more attractive our money is, the more likely it's to be used, right? And then the financial inclusion stuff, basically give it to everybody so everyone's included. Yeah. And then the more public safety stuff. And so here's one of the cash things. So according to a 2020 survey, U.S. consumers used cash for 19% of total transactions, 6% per value or by value. And then in some jurisdictions, for like foreign countries and stuff, that's later. In some jurisdictions, however, digital payments have rapidly supplanted cash, while cash use in the United States fell from 40% of transactions in 2012 to 19% in 2020. Other countries have seen much different. So, like they say in Sweden, it went from 33 to less than 10% in the same time period. And then in China, it went from, looks like 50 to 13. So, yeah. And here's the footnote that I was talking about, how historically physical cash has been the most frequently used instrument for payments under $25. So again, and also one thing to keep in mind is like, look at all of the links they have. Like almost every single footnote has a link with it, especially if they're citing something. So that's always helpful if you want to go in here and look for yourself, and see kind of read more of the publications and stuff like that. So like after I'm done, like for example, with this money and payments one, some of the footnotes and the citations they use, I'll go through and I'll read like each kind of publication, like, yeah, just to kind of continue. It's very interesting stuff, I think, seeing kind of the way they're spinning it. And I don't know if to say the way they're spinning it is the right way, because it also definitely implies a very cynical view. But I think whenever you're talking about changing the underlying form of money in some way, or even just adding a new one, I mean, you have to be cynical, at least in some form, just because there is such a thing as a slippery slope. And depending on how far you allow yourself to go down that, you might not be able to stop. So we're just going to leave it at that, and you can take from it what you wish. But yes. Anyway, on the next video tomorrow night, we'll continue with the next section, and just because this video is already almost 30 minutes, so I don't want to do them way too long. But anyways, I hope you guys have a good night, and I will see you tomorrow.